You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. And on today's show, we're talking about 162 double bonus, but this time we're using restrictive endorsement bonus arrangement. We have all the docs, all the samples, and all the illustrations. You won't want to miss the show.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm Steve Savant, and we're broadcasting to a nationwide audience of financial professionals right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today, day 5 and all this week, Ken Davis, CLU, CHFC, CFP, and CPA.
Hello, Stephen. Good to see you.
I have that down better than you do.
Yeah, I think you do. I think you're the one that announces it. So.
I love it. Well, you know, I like having Ken in here. Ken is one of the few CPAs who get our practice, and I have to say, Ken's starting to develop his own cult following among CPAs that are getting this. I mean, you've spoken at the fiduciaries, or attorneys, trust officers, CPAs. People listen to Ken because of his credentials. He was the president of the local chapter here for years, and they look to him. They look to him and say, okay, what's going on here? And he demystifies and debunks it. He thought it was snake oil salesmanship on my part 20 whatever years ago, but now he's found out that, hey, there are some really good things. And today, we're talking about a specific way to do Section 162 double bonus using this restrictive endorsement bonus arrangement. It's kind of a concept that has a few docs. Why don't you walk us through the mechanics? We got the mechanics, I think, of 162. Hopefully you've been watching the shows all this week, and you need to before you watch this show. Would you say yes?
I would agree.
Okay.
We want to, here's our cautions, and these are things that we have to be careful of. First of all, in something like this, while it's one of the most simple programs for this type of executive comp that exists and has the least issues, you still have to have your attorney/accountants involved in the process to make sure that the legal aspects are done properly. The things we need to avoid are ERISA, which normally applies to qualified plans, and Department of Labor, and sometimes some other issues pop up. The beauty of this is we have sample documentation that can be given to the attorneys, accountants, whether or not they know what this is or not. Mm-hmm. We can give them documents that explain the concept, make reference to the code sections, the revenue rulings, the treasury regulations, all this stuff, because they want to make sure they're protecting the client. We can't force them to go out and do all this research. They'll say no. The client won't pay for 50 hours of research and time. We can summarize that, make it easy. They can look quickly and say, yeah, this addresses the issue, and it was issued by legal departments, but ultimately their attorney that represents the client has to look it over. But that helps them get it done. The other impediment to getting this stuff done is also the documents themselves. And the documents here are really quite simple. First of all, this can only be offered to top hat types of employees, typically people who are in a position of power as an executive, or in some cases partial ownership, stuff like that. We need to make sure that those people get offered. Secondly, it can't be a plan. A plan is where it's a general plan offered to a whole bunch of people. Each of these contracts is individually negotiated with each of the employees that are being covered. And they could be very different or they could be the same, but they have to be negotiated separately, okay? And these are all the issues that the attorneys tell us from some of the advanced marketing departments that you have to look out for. And so we don't want to fall into ERISA land, we don't want to have Department of Labor issues and all that stuff. So it has to be key employees, and it has to be individually negotiated contracts. The beauty of that is if it's done right and you stay out of those problems, and they're not difficult to stay out of, I don't think, then they can be completely discriminatory. Not just how much is paid in and for what period of time, but for how long they have to stay in. And we haven't really talked about vesting benefits, but we're going to be talking today about restrictions on it. So that's the basic model. The key documents are an employment agreement, which is entirely separate from the contract. The employee owns the contract. The employer is going to potentially put a restrictive endorsement on that to keep the employee from cashing in or using it as a loan or using it for other purposes. But even if the employee walks out, the employer has no rights to any of that cash. The restrictive endorsement means the employee can't get their hands on it, but the employer has no ownership rights, and that's really key. Employer cannot have ownership rights. So The restrictive endorsement doesn't.
So there are two separate documents. One is an employment agreement,
Right.
and the other is a restrictive cash value endorsement.
Right. And frequently the insurance companies will have the restrictive endorsement form, or we can supply you with samples for the attorney. The other part is the employment agreement. That is an agreement that's totally separate from this, that says, Mr. Employee or Mrs. Employee, if you were to leave our employee before this, you're going to owe us part of these premium payments that we've paid back. And just as an example, it could be a 5-year rolling vesting. They vest 20% on the first premium, first year 40, 60, 80, 100 over 5 years. Then the next year starts a brand new rolling situation. The beauty of this is you don't have to do it any one way. It's whatever the employer wants to do.
Now, I just have a question on real quickly before we go to break. Employment agreement is not a vesting schedule.
No, but it is not a vesting schedule, but it has the effect of a vesting schedule. It basically says if you leave, you have to pay us back some money. Makes no reference to the policy whatsoever. They don't care where the money comes from. They have no ownership rights in that contract. Just simply, Mr. Client or employee, you owe us the money. Now, the employee, where are they going to get the money? Well, if they owe, $20,000 and the policy has $30,000 in it, they're going to go to the policy and take the money out as a loan and/or withdrawal, tax-free. Use that to pay the employer. The employer then signs off and releases the restriction on the policy, and they walk with it.
So it's really a little different than the kind of schedule I think about when I think about vesting. This is really an employment contract, completely separate from the policy,
That is
separate
right.
from the restrictive endorsement.
Right.
It's really a standalone doc.
It is.
We have all this. Again, if you want to order it, just call me or write me at thebiz@brokersalliance.com, and we'll send it right to you. Remember, you can contact me at that address because it's golden, thebiz@brokersalliance.com, or just call me, 1-800-290-7226. And don't forget, you can watch this show and all our shows this week right out at www.brokersalliance.com. Just hit the red on
You're
archive
listening
button.
to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Companies in our business are always touting service, products, and underwriting. And we do that too. But here's the difference. Now enter the world of the elite producer with a value package that cuts us out of the pack. A BD that approves social media marketing of non-FINRA products and doesn't take an override. With the best competition desk in the industry, and for our loyal producers, a true group health plan. No one offers that. Brokers Alliance does.
Well, welcome back to the Business Insurance Zone. I'm your host, Steve Savant. And remember, Ken and I are talking about 162 bonus. So before proceeding, always make sure you check in with your tax advisor. And if you're security licensed, always check in with your compliance department of your broker-dealer. And speaking about broker-dealer, again, just a reminder, our broker-dealer is really good about being benevolent towards the way we use language in non-FINRA products. So if we tweet, we blog, we write articles, client communication, they're really pretty good about that on non-FINRA products. And keep in mind that one of the big things that they have, and we think, is they don't take a haircut on our products that are non-FINRA. So if you're interested in that, just write me, thebiz@brokersalliance.com. Say, Steve, I'd like to know more information on your broker-dealer, and we'll send it to you. Now, we're talking about something today a little different here, Ken. Really, when you think about it, we're talking about a 162 double bonus, but now we got some more paperwork here, and we're doing it so that everybody is protected. The employer is protected, the employee is protected, and even though we're not really using this phrase that I'm so used to, vesting schedule. It's really not a vesting schedule, is it?
No. Well, we achieve a vesting schedule result, but
Right.
it is not a vesting schedule per se, not in the sense of a qualified plan, because the qualified plans put restrictions on what they can look like. We have no restrictions. We can set it up however we want to, as long as the attorneys make sure we're in compliance with the laws and don't fall into ERISA or Department of Labor regs. So,
I'm thinking about how long do people do 162 bonuses now, because it seems like people move to different corporations and different companies. I'm wondering, in a contract, to really make it really good, I think you really have to have some minimum time in it to really make the contract perform. So I can't see doing anything less than 5 years. I mean, it seems like, especially with what the product we're using as a bonus program, you have to be in it for kind of a mid to long-term arrangement.
well, and that's kind of a secondary the penalty, early withdrawal penalty, is another reason why the employee should stay. And that's what we're trying to do here. The employer wants to attract new talent, wants to retain existing talent. I mean, that's the whole purpose of executive comp. And we're just now introducing on the second bonus, the restrictive endorsement, which gives the employer some control over the employee. Mr. Employee, you're going to have to stay around a few years, because if you walk away, yes, you're going to be building cash value that's yours, and we always want to have the cash value exceed what you owe back to the company. However, we want you to feel the pain if you leave too early. You're a valued employee, and this is a major compliment to you that we're doing this for you. However, we're protecting ourselves. We're making a substantial additional investment over and above your normal compensation, and we're doing this because we value you and want to keep you around. Interesting point. One of the documents I saw from one of the insurance companies makes a statement, and I don't know how true it is, but it's pretty dramatic, that it costs about 300% or 3 times the annual salary of an executive to replace them. Now, if you think about it, the key employee's gone, they're not productive anymore, there's a gap in coverage, maybe sales are down or whatever, if it's your marketing guru, then you have to pay an executive search company. I mean, there are a variety of different costs, so I could see where that could add up. So, paying somebody that's making, 200 grand a year an extra $10,000 or $20,000 in bonus is a whole lot cheaper than trying to replace that person and having the downturn, and maybe them now competing or taking that business elsewhere. So those are some of the reasons. But the restrictive endorsement is this golden handcuffs type of concept that says, Mr. Employee, if you leave, we're going to ask for some money back. And so that helps. The fact that there's early withdrawal penalties, you're right, it has to be in place for a while. We know that it takes 10 to 15 years for the numbers really to look good in a cash value policy. And the beauty of this thing is it is portable. So from the employee standpoint, now switching gears, they may not get those contributions, but there's nothing stopping them from asking their new employer to make the contributions or to make them themselves.
Yeah, I would think that you would want to figure that out before you left. Hey, is this new guy going to pay this, pay into my executive bonus arrangement? And I think one of the things that I like about this is we're trying to make it win-win for everybody. It's not heavy on the employer side. It's not heavy on the employee side. It's really a balanced approach, and we're using this. This is a great strategy to help build out your practice. If you've said, Steve, I've really not done this, I think you'll be surprised at how many employers will be warm to this idea just because of the one singular issue of key employees and trying to retain them. And when you lose them, the cost of finding somebody, integrating them into their system, the learning curve to join their corporation, all those things are expenditures. And you said, what, 3 times the comp? Well, I think it's easier to pay 10% of our comp than 3 times the comp.
Sure, and I don't know about you, but I've been in actually with small employers. I went to an electrical company one time, and he was telling me about his employees, and this guy's been here 20 years, and Susie's been here 30 years, and Jeff's been here 40 years. And those people, I said, what does it look like if they walk out the door? What does it look like if they pass away tomorrow? What happens to their families? You guys are like family around here. How do you feel like if somebody's unemployed and Mary and the kids don't have money to live on, And so we forget, we were talking about the economics, but the insurance part of this is important. And that can be used to protect the family, can be used to pay for taxes. There's a lot of different, state taxes, stuff like that. There's a lot of reasons to have this kind of thing.
Some people use it as a fulfillment idea because the indemnification or the death benefit can fulfill the retirement in case of early death.
Sure.
And some carriers, depending upon the limit, will let you put waiver of premium, not cost of insurance.
And disability.
The waiver of premium. So if you're disabled or you die early, it has a contract that self-fulfills. I kind of like that.
Yeah, it works well, and it's a good substitute for disability when you're overstuffing and insuring that with the rider.
We're talking about a restrictive executive bonus arrangement. We have all the docs. Just write us at thebiz@brokersalliance.com. We'll be happy to send it all to you and work with Indexed Universal Life. You can listen to our show and all our shows right out on www.brokersalliance.com, where you can just hit our on-demand button or call us 1-800-290-7226. That's the Buzz on the Biz. You've been in the zone, the business insurance zone.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, We're the news you can use.